Welcome back, everyone. Buckle in your seatbelts. This is going to be a long one. What we're going to cover is the service and supply sector of the oil and gas with an emphasis on the offshore. And what we're doing is we're looking at the earning conference call transcripts and trying to parse out what it is they're saying in regards to the offshore sector. Some commonalities that they cover is Brazil, Guyana, and Saudi Arabia. Multiple emphasis on a multi-year growth cycle. They're speaking about quarter over quarter and year over year improvements in orders and backlogs. They speak in regards to the price agnostic and the price inelastic demand and rush to secure supply, whether that be for the rig itself or whether that be for services or whether that be for parts. And what we're looking for is continuity, flow through, and follow through. So if Transocean, Diamond, Valaris, name your player, is talking about activating rigs, that's going to require parts, updates. And then the question is, are we seeing that on the other end, on the people with the parts? And the answer is yes. So without further ado, let's get into this. And this is more of a listening one. If you're on a long car ride, this will be perfect for you. Or if you just don't want to look at a screen and just want to listen. I'll let Weatherford International sum up this slide deck for the too long didn't read, or in this case, the too long didn't listen crowd. The outlook for international markets continues to demonstrate strength with the Middle East and Latin America leading the way. Additionally, we see incremental opportunities in Asia, the Mediterranean, and sub-Sahara regions, driven by robust offshore project sanctions and startups. We expect to see the broader Middle East region grow north of 25%, followed by Latin America in the mid to high teens. There will be volatility driven by customer project timing and supply tightness, the willingness as well as FX. They're witnessing as well as FX in certain international markets, but the organic activity growth is very encouraging for the next few years. So we're doing 4 companies. It's not an exhaustive list, but this is an exhaustive enough slide deck. So it gets the point across through enough players. So Schlumberger. So what we're going to do is we're going to read the parts of the earnings call in which they talk about offshore, including any questions that people might ask and the responses, insofar as it, yet again, has to do with offshore, because that's what we care about here. Moving to the macro, we maintain a constructive multi-year growth outlook. Through the first quarter, the resilience, breadth, and durability of the upcycle has become more evident. I would like to take a few minutes to describe these factors. To begin, the underlying demand, investments, and activity during this cycle are resilient despite short-term economic and demand uncertainties. The combination of energy security, the initiation of long-cycle projects, and OPEC's policy sets the condition for decoupling of the activity outlook for short-term demand uncertainties. Indeed, energy security remains a top priority for most countries and is driving structural investments that are governed primarily by national interest. The extent of these investments is resulting into a broad-ranging growth outlook, comprised predominantly of resilient long-cycle projects in the Middle East, the international offshore basin, and in gas projects. Collectively, we expect these market segments to reach or exceed more than 2/3 of the total global upstream spend and support a long tail of resilient activity over the next few years. In parallel, the North American market, characterized by high short cycle exposure, is also set to benefit from positive demand outlook and supportive commodity pricing. However, this will be impacted by an anticipated activity plateau in the short term, which will subsequently be reflected in production volumes. Moving to the dimensions of breadth and duration, These are also best emphasized by the latest activity outlook for the Middle East and offshore market segments. Fundamentally, the pivot to both segments as anchors of supply growth is a defining attribute of this cycle. This is providing an unprecedented level of investment visibility and scale that is setting many records. In the Middle East, the largest ever investment cycle has now commenced. This will support ongoing capacity expansion projects over the next 4 years in both oil and gas. Consequently, this year we expect to post our highest revenue ever in the Middle East, putting us on track to achieve our multi-year growth aspiration. Simultaneously, we are witnessing further activity expansion in the offshore market. Offshore activity continues to surprise to the upside with breadth and a diversity of opportunities across all major basins. In addition, the latest FID projections and industry reports indicate that the offshore sector is set for its highest growth in a decade with more than 200 billion in new projects through the next 2 years. This growth will be supported by 3 layers of activity. First, the resumption of infill and tieback activity in mature basins, which was very visible across Africa in 2022. This will continue to strengthen in multiple geographies from this year onward. Second, ongoing large development projects in both oil and gas that are ramping up and starting to scale. This is evident in Latin America, such as Guyana and Brazil, and in the Middle East, such as in Saudi Arabia, UAE, and Qatar. And third, the resurgence of exploration and appraisal activity, which is starting to gather strong momentum in the existing basins and new frontiers. From West and South Africa to the East Mediterranean, we are starting to see exploration and appraisal at a pace that was unforeseen just a few months ago. Additionally, the activity pipeline continues to elongate with new licensing rounds and new blocks awarded. As a result, we believe that we'll continue to witness durable offshore investment for many years to come. As we believe this cycle is unique through, as we said, element of resilience by the nature of investment and growth rate, including the long-term capacity expansion committed in Middle East, including the large long cycle elements that are growing in proportion led by offshore deep water coming back. The breadth, I think, everywhere we go, every geo unit is seeing customer reaching out to mobilize resource, sometimes for a short cycle production enhancements, most of the time for development, commitment of assets and redevelopment expansion from infill to large scale development. And durability is certainly improving, and duration of the cycle, I think, is improving as we see. Because beyond the Middle East's 2027 targets of capacity expansion in the country, other countries are targeting this towards the end of the decade. And here, I'm in the city in Brazil. Brazil has a clear ambition for 4 million barrels by 2030, and I've already committed up to 20 FPSO contracts that will continue to build a pipeline of offshore activity, subsea in particular, going forward. So I'm very positive about the mix, if you like, of short cycle or production enhancements to address the anticipated supply risk and the long commitment from the Middle East, from deep water and offshore operator to commitments in the long cycle. It's not to offset and not now take precedent over the short cycle and so turn. As we indicated, a turn into the cycle towards international offshore and Middle East in particular. So that's where we are very confident. So here's a question by James. Okay, that's perfect, Oliver. And then a follow-up for me. In terms of pricing, international and offshore versus maybe North America, what you're seeing there in terms of level of concern, or maybe not concern, but level of willingness to accept pricing increasing? It seems to me like customers internationally and offshore are more looking at or concerned about availability of service capacity rather than what it actually costs. CEO says, Yes, I think we are seeing pricing tailwinds. We have seen pricing tailwinds in the global market for quite a few quarters and starting in North America. It has turned to international based on two things. First, indeed, securing capacity going forward, considering the tight supply of equipment, unique technology, giving a level of sense of urgency to secure contract and elongating the contract. You have seen example of 9-year contract into the announcement we made today. And at the same time, I think performance matters. Performance matters to offshore operator. Performance matters for first gas, first oil. And there's a sense of urgency to accelerate the cycle. This is one of the priority. And technology integration also makes a difference and is recognized and is driving a price premium. So the combination of supply capacity, the combination of, I would say, a sense of urgency and quest for performance integration and technology deployment is driving pricing tailwind that are serving us very well. Another question. And was the North American uptick, was that more offshore driven than onshore this quarter? CEO. Yes, it was indeed. Absolutely. I think offshore is not only international. I think offshore is happening in North America. North America as Northeast Canada, Alaska offshore, and Gulf of Mexico, the combination of which is set to grow and outpace this year. I would say the U.S. land and North America land activity. So we are also getting the benefit of our fit for basin success in North America that continues to hold and help us maintain, grow our share, and come on a premium on pricing. So, ladies and gentlemen, I think I want to give a close to this call. It's almost to the hour. So to conclude today's call, I would like to leave you with the following takeaways. First, the quality of the unfolding upcycle in oil and gas is improving with unique attributes of resilience, breadth, and duration. This is very much evidenced by the strengthening outlook in both Middle East and offshore markets, and further reinforced by the tight supply balance as demand forecasts approach new highs at year end. On to the second one, NOV. And with production growth targets announced by the national oil companies around the Gulf slated to come from far more complex wells and reservoirs, is becoming clear to operators that the region has no choice to upgrade its suite of rigs, stimulation equipment, bits, and downhole tools. Our customers faced lower commodity pricing and global recession fears during the first quarter that showed no signs of diminished appetite for the goods we provide. To the contrary, our orders remain strong and customer conversation robust. In all likelihood, North American activity is at best flat for a while, constrained by $2 gas and tepid oil prices. But offshore activity in Brazil, Guyana, the Gulf of Mexico, and West Africa, along with land and offshore activity around the Arabian Gulf, point to strong growth over the next several years, underpinned by expected project FIDs and double-digit E&P CapEx growth plans. Rising technical and equipment specification and tenders for the Middle East are requiring the revitalization of drilling fleets that we have been expecting for some time. Similarly, tendering activity for offshore markets will require the need to continue reactivating rigs, and we are beginning to get quite deep into the stack. Simply getting some of these rigs back into working condition is becoming a much bigger job, but most of the rigs also require meaningful upgrades to conform with operator requirements. We expect all of this to translate into a continued improvement in rig capital equipment order through the rest of the year. Increasing activity, reactivations, and upgrades are driving strong demand for aftermarket products and services. During the quarter, our rig aftermarket operations posted a 13% increase in spare part bookings, our fifth consecutive quarter of improved orders, and the best spare parts booking quarter since the third quarter of 2019. We expect demand for our aftermarket operations to remain robust based on the recent bookings and quoting activity we have seen from our field engineering group. All three of our segments participating in the offshore, and I think it's fair to say all three segments as well as our peers in oil field services, the offshore generally is a higher calorie sort of environment. And so I think while there's so much enthusiasm across oil field services with respect to the offshore coming back is the fact that it's been largely absent since 2014. And so just to run it down, obviously Rig Technologies, as the leading OEM provider of equipment that's seen on almost all the offshore rig fleet, as those rigs go back to work, we're the kind of the first call drilling contractors make when it comes to reactivating their rigs to upgrading their rigs, which is why we are seeing rising demand for activity in shipyards around the world. I think I mentioned in my prepared remarks that recertification of rigs, special purpose surveys, upgrades, and reactivations, we now have 55 projects underway in shipyards to support that effort, along with kind of the day-to-day aftermarket spare parts. And what we are particularly excited about is the adoption of technologies we develop for both land and offshore. But in the offshore, and mentioned ExxonMobil standardization on their offshore fleet for the Guyana development. In completion and production solutions, it's a little more downstream, and so the excitement there is really focused on FPSOs. We have a number of conversations underway with producers around our gas processing technology, our swivel turret monitoring systems for FPSOs, lots of areas in the world that we are market leader, and then finally on well bore technology. As these rigs actually go back to work, they operate at very high day rates, and so efficiency matters a lot. There's a tremendous amount of focus on efficient well bore construction operations, and I am excited about the technologies that we have in digitally monitoring and optimizing those operations and the impact we are going to have as the rig count gets back to work. If you look at the offshore rig count, the rig's actually turning to the right. We're still not back to where we were in the first quarter of 2020, but it's clear to all of us in the space that the puck is going in the right direction. There's been a lot of E&P conversations around FIDs on developments that we have all been working on for the past several years that are now finally starting to move towards and excited about the impact on our business. And then with respect to the offshore, we are hearing this from all over. More offshore rigs going back to work. And we, of course, work closely with the drilling contractors that run those rigs, along with providing services directly to those rigs. And for instance, our brand business, our waste management, drill cutting processing business, they are rigging up on a lot of offshore rigs and anticipate better things in the second half of 2023. As more rigs spud and these programs get underway, and we can provide services directly into those. Likewise, our tube scope business, its pipe operation here on the Gulf Coast, staying a lot more offshore pipe coming in support of offshore operations. So really, all around the world, everyone is kind of looking at the same data set and seeing growth ahead in the offshore. Oil States International. During the first quarter of 2023, the company generated EBITDA of $21 million, representing a sequential increase of 4% on revenues of $196 million. We generated net income for the third consecutive quarter, driven by growth and a favorable demand mix in our downhole technologies and well site service segment, along with strong contributions from our offshore manufactured product segment. Backlog at our offshore manufactured product segment increased 6% sequentially, totaling $326 million as of March 31st, driven by quarterly bookings of $118 million, which yielded a quarterly book-to-bill ratio of 1.2 times. Our first quarter bookings included 3 notable project awards exceeding $5 million each. We are also pleased to report the receipt of our first 2 contracts awarded for our newly developed managed pressure drilling equipment. Global oil and gas inventories have recovered and are now within their 5-year seasonal average for crude oil, but are now significantly above the 5-year average for natural gas, which has led to lower gas prices year over year, tempering expectations somewhat for growth in drilling and completion spending on U.S. land activities. However, we have begun to see an inflection upwards in international and offshore markets, which will further support our product and service offerings in global regions. Given the steady levels of frac spread utilization over the last several quarters, we expect our well site services and downhole technology segment to continue to perform in line with or better than market activity indicators. Revenue in our offshore manufactured product segment are expected to continue to grow, especially in the second half of 2023. Let me interject here. You keep hearing this time and time again of second half of 2023. Second half of 2023. Which is interesting because a lot of people's calling for recession in the second half of 2023. But I digress and let's get back to reading. Given strong order flow and increased levels of backlog along with ongoing short cycle product demand, given these market trends and indicators, we believe that we will achieve the upper end of our prior annual guidance range. Question. Cindy, can you talk a little bit about what you're seeing on the offshore order flow? I know your book-to-bill was good. You mentioned a little bit, I think it's in prepared remarks. I'm just curious about the conversations you're having and the visibility that you think you have, which should go over the next few quarters as far as order flow. CEO. No, that's a great question. Thanks for posting it. Our bookings outlook is very strong. I'm trying to look things back to our 2022 bookings, and I think the bookings were up about 29% or so. What's happening? Revenue's growing, and so a book-to-bill of north of 1 implies obviously growing bookings. Our bidding activity has been robust and broad. Of course, there's a lot of bidding activity around our conventional subsea proprietary technology in both Brazil, Guyana, and other basins. But obviously, those 2 basins are very, very strong. And again, we're very pleased with some of our new production introductions, particularly our high-pressure riser systems and our MPD equipment, both of which are getting good market attention, and we're beginning to see some order flow there. Tenaris. We're halfway through, people. A little over. Our sale of Wedge Series 400 connections designed for shale application and our sale of dopeless connection and Blue Dock and Easy Dock connectors for offshore application also reached a record level, implying record demand, which, during the year, we expect our sales of this specialized product as well as our Wedge Series 600 and new Blue connections to exceed the previous annual records. While North America was the main driver for our sales growth in 2022, this year's sales for offshore projects into the Middle East will rise strongly. In the first quarter, sales to offshore projects around the world rose 40% quarter on quarter and will increase further in the second quarter to represent close to 20% of our sales of tubes. Question. I want to ask you some questions about the longer cycle markets that impact your business over the next few years. Maybe talk about offshore markets a little bit. We're seeing a wave of rig counts in the last 12 months. So subsea orders are piling up. FTI has had some nice numbers this morning, and now hearing service companies are talking about the opportunity as well. Can you just talk about how you see the offshore impacting your volumes and kind of when you should start hitting? Is that a second half of 23 event for you? Is that more of a 24 event? And any markets in particular stand out for Tenaris offshore wise? CEO. Thank you. The offshore drilling continues to increase steadily. The global offshore rig count already reached the pre-pandemic levels, and everything indicates that this will continue to grow. FID projections, CapEx projections, the discussions that we have with our various people indicate that it's going to be a multi-year growth cycle. We are quite confident about that. And what we perceive, this is also happening in many basins at the same time. Tenaris, as you know, is an undisputed leader in this segment with a differentiated product and service portfolio. So we are very well positioned to take advantage of this trend. I would mention, for example, that we are ramping up shipments in Latin America, long-term agreements that we have with Brazil and Guyana. These are two key deep water basins that will experience growth over the next few years where we supply differentiated technologies. This is one area that we continue to grow into 2023 and beyond. Another hot spot has been the offshore seamless pipelines. We see a lot of activity in building infrastructure to support this increased drilling. In the last few months, we have booked several deepwater pipelines in North Sea, Sub-Saharan Africa, Black Sea. So we see this area also as a bright spot in the future. So overall, we believe that volumes are going to increase. This is already happening in Q1, and this will continue to happen in the rest of the year. But we believe that this is going to be a multi-year cycle. Another answer. Regarding prices in the international market, we see a strong momentum following the increase in demand in the Middle East and offshore that was mentioned earlier. The market is already tight, and we are in the early part of this cycle. So we believe that the market will become tighter. This is particularly noticeable for high-end products, special grades, premium connections, complex pipelines where we are particularly strong and focused. So in this environment, customers are prioritizing supply rather than price. We heard about that earlier in a different company's call. So we expect that there's going to be pricing tailwinds supporting our business in the international market driven by Middle East and offshore with some legacy and timing from contract renegotiation or contract booking into our books because, as you know, in this part of the world, there is a typical legacy of 6 to 9 months or even more these days to see that into our shipments and invoicing. All right, we're done with that. Now that I'm losing my voice and irritating you with my water sipping noise unprofessionally, this is the weekly performance, and well, it's not too impressive. I don't know. I added a share of uranium. I'm going to talk about uranium next week. Transocean is whatever. Transocean reports earnings after the close on Monday. Diamond does as well. I don't own Diamond, but Transocean reports earnings Monday after the close. See what happens. The problem is when you have an up market, or at least a sideways market, and a company reports earnings and they're mediocre or good, they go up a lot. But in down markets, which I'm perpetually paranoid about, and so far it's been unfounded, but selling may go away, is when my companies, because none of these companies have reported earnings. Well, I think Kinross did. Anyway, none of the offshore companies have reported earnings, nor has Louisiana Pacific. And Cameco reported earnings today, which is the uranium sector, which is a respectable portion of the spot uranium ETF, is that if we get a down market in May, when pretty much all of my names report, even if they're good, it's not going to look good for them. Like if the home building product providers and manufacturers reported alongside the home builders in this past couple of weeks, they probably would have done much better than they have in the past week. Treading water is really all they've done. Which they're not looking the best either. Well, Builders First Source, but I don't own that because I seemingly can never get in a position. Is Blue Lynx, Louisiana Pacific, Boise Cascade have just been trading in essentially a consolidation range for the past year, while the home builders have been more volatile, but they're more up and to the right. They're at least sideways and to the right, if not up and to the right, while Blue Lynx, Louisiana, Boise Cascade are just in this volatile trading range for the past solid year. But of course, the overall market's been what? Where we close today is also approximately, I believe, the same place. You look this up on a chart, is approximately the same place that we closed in April of last year and of April the year before. It's, a lot of chop. Anyway, that's that. I'm going to end it here. I'm tired of talking. Thank you for watching and listening, and until next time.